The sell-off in US stocks that we've been seeing this week has meant that the bounce back didn't quite make it back to new record highs. As we discussed in our video last week, there were a number of obstacles in the way of the BTFD train, and perhaps the biggest one is coming today with the conclusion of the Federal Reserve's December meeting and their monetary policy announcement. But you know, that uncertainty this week hasn't stopped everyone. Someone made a really big, bold, bullish bet yesterday worth $65 million as they bought 20,000 call spreads linked to the S&P 500 that expire just before Christmas. So, very brave. Will they be having the Christmas of a lifetime, or will everyone be receiving coal in their stockings? Well, a lot of it will depend on what the Federal Reserve says today. So let's take a look at what we expect the Fed to do. We'll go through three sections: their asset purchases, what they're likely to show about possible interest rate rises, and what we need to be paying attention to in their statement and the press conference. And all I ask for you for all of this is the little thing of raising interest in the thumbs up button and give us a little like to help support the channel. So let's get started with the asset purchases. Just last month, the Federal Reserve announced the start of their tapering process. They are going to be reducing asset purchases by $15 billion per month, which would mean that they'd be finished by the end of June. But now it's expected that they'll double the pace of this tapering and cut by $30 billion per month, starting in July, meaning that they'll be finished by the end of March. Now, this isn't going to be a surprise. It's likely to be priced into the market. We had comments from Fed members for a while setting the scene for all of this, and then the head of the Federal Reserve, Jerome Powell, made comments recently confirming that they would be discussing accelerating their tapering. Now, the reason for tapering quicker is to allow them to have the chance to raise rates sooner if needed, since they'd only start raising rates after tapering comes to an end. So obviously that means in terms of interest rates, it's clear we're not going to be seeing a rate rise at this meeting. Instead, the key focus from that side of things is on the timeline for rate rises, and we'll be seeing the release of their dot plot, which shows the interest rate projections from the individual members of the FOMC. In September's dot plot, which was the last one, the committee was pretty evenly split between members who thought the first rate rises would come in 2022 and those who thought it wouldn't be until 2023. However, it's now expected that this will change, with the majority now showing 2 rate rises in 2022 and 3 in 2023, therefore giving a much more hawkish sign from the Federal Reserve. And the Bank of America has a global fund manager survey which shows what their expectations are, and the December figures showed the highest level of expectations in 3 years for higher short-term rates. It was a net 86%. This is based on a panel of 371 fund managers with a combined assets under management of around $1.1 trillion. And a survey from the FT on economists found similar expectations, but perhaps even more extreme in some ways, because 10% of the economists in that survey thought the first rate rise might come as soon as the first quarter of next year. So if everyone's expectations are pretty much aligned, where might the surprises be from this meeting? Well, first of all, it would obviously be quite a surprise if the Federal Reserve were more dovish than expected and the dot plot didn't show the timeline for rate rises that everyone's expecting to see. But more than likely, any possible surprises will come from the statement and the press conference. The first thing we can expect to see in the statement is a change in wording about inflation. Based on what Powell said recently about retiring the word transitory, I think it's safe to say they're going to stop saying they expect inflation to be transitory in their statement. As you might expect, they'll probably also point out that there are new risks coming from Omicron, the Omicron variant, so no big surprises there either. But the first interesting part will be on interest rates. Powell is likely to be questioned about the dot plot, and we can expect that he may want to distance himself from it a bit. He may point out that the dot plot shows individual projections rather than a view of the committee, and therefore is not a signal of future policy action. And this may actually be the case as well. We know that President Biden has 3 Fed board nominations to make, and it's likely that this will lead to the FOMC in 2022 being more dovish than the current one, and therefore meaning that the current projections from members might not actually be in line with what the sentiment is next year. The next interesting part will be any comments from Jerome Powell about the Fed balance sheet once tapering comes to an end. We have a pretty good expectation of the tapering timeline now, but just how quickly the Fed might start reducing its balance sheet will be the next thing that the market's paying attention to from that side of things, so interest rates aside. In terms of inflation, PPI data that came out this week showed the highest level since records started a decade ago, with the year-on-year figure showing a massive 9.6% rise. And if you're not sure what PPI is and why it's important, click up here to watch Saturday's video about PPI. It's from our series that's all about economic data, which I definitely recommend watching. So this data release may be showing that the economy is now seeing a more generalized rise in prices that's broader and less directly linked to the pandemic than what the Federal Reserve had first assumed. We're also seeing record inflows into inflation-linked assets. There's been $66.8 billion into funds holding Treasury inflation-protected securities, TIPS. We've had people like Bill Ackman announcing inflation-related positions. You know, Ackman told his investors in his quarterly call that he had a $170 million bet on inflation that was then worth $1 billion. So once again, Bill Ackman strikes again during the pandemic. The thing is, economists like Mohamed El-Erian and Larry Summers are appearing left, right and centre on every media outlet, warning about the impending doom from inflation and the Fed's current course of action. Like just this week, El-Erian has been saying that the Fed thinking that inflation was transitory is the worst inflation call in the history of the Fed. It's quite an inflated statement there. And all of this builds a narrative in the media that consumers are much more likely to pay attention to than whether the Fed changes their wording from transitory to persistent. But if we look at this chart here, posted in the Heisenberg report, we can see that CPI inflation is mooning, it's heading to the stratosphere. Meanwhile, expected inflation is still relatively tame in comparison. So I think everyone accepts that the reasons for inflation this time around aren't really something that the Federal Reserve can tackle directly with monetary policy. So instead, any action that they take would be having an effect on expected inflation. So the ironic thing is that since people are much more likely to be panicked by what they see in the mainstream media than what they see from the Fed themselves, all the media narrative is doing is pouring fuel onto the fire that they're supposedly trying to put out. So instead, why don't we all pour fuel onto the fire of this channel by hitting the like button? And if you want to understand more about economic data, check out this playlist where we're covering all the economic data releases and explaining how they connect to each other. Make sure you subscribe to the channel for more, and thanks for watching. Take care.